is you'll see it clearly, the drop, the drop, the pause, the drop. So in each one of these drops, all right, we can start the drop from here, right? Drop. The pause was very mild. Did not bounce way up there or anything like that. It stayed in the bottom third, right? And drop. Now your pause stays in the bottom third of the next drop. Now look at this drop, but your rally gets past the halfway mark, which means that now this next pullback should go. You see that? Over and over and over again. Guys, what I'm teaching you here today is elementary. It's basic in the technical world of trading. But the nuances I've gone into make this come alive way more than just knowing the definition of these things. All right? Knowing specifics like the percentage that changes something. The further it gets away, the lower the odds drop. The clearing of 5 bars, not the whole base. All of those nuances make this extraordinarily valuable. Tail bars. Now, there are really kind of 6 type of tail bars. I have 4 here, but they all fall into 2 different categories. There's what we call bottoming tail bars, where the tail of the bar is at the bottom and the body, the little body, is at the top. Now, this is a very important concept here about tail bars. What makes a tail bar truly a tail bar is that the majority of the bar's range from high to low is tail. So the majority of the bar's range is tail, and the body at the top of the bar is small. If you have a body that is not small, but also part of a tail, that's not a pure tail. A pure tail bar is the majority of the bar's range is tail. So it's almost like a snowman. All right? Almost like a snowman, where your tail represents the vast majority of the bar's range. The head or the body, whether it's green at the top or red at the top, represents the smallest part of the body. Then you have your topping tail bars, right? This is where the tail is at the top of the bar. And so it's an upside down snowman, where the tail represents the vast majority of the bar's range, but the body being at the bottom, whether it's green or red, represents the smallest part of the bar's range. Now, tail bars can be viewed more as torpedoes, if you will. So this looks somewhat like a torpedo. And since the torpedo portion of it is at the bottom, you're looking for upside after bottoming tail bars, and you're looking for downside after topping tail bars. So think of these bars more as torpedoes. Now, notice that there's a green top and a red top for each version. Bottoming tail bars can have a green top, bottoming tail bars can have a red top, and vice versa. Topping tail bars can have a green and red bottom. Now, the different colors don't make a great degree of difference. It's literally the tail that possesses the vast majority of this bar's power. So as long as you have a decent tail, the top really doesn't matter that much. The odds of follow through are very, very strong. Now, remember I told you that the elephant bar that'll represent 60 to 65% of your trades, right? 60 to 65% of your trades. The tail bar will represent about 15% of your trades. So with elephant bars, let's say you're around 60%, and tail bars, you're around 15%. So just with elephants and tails,
you have the vast majority of whatever the market throws out to you in the terms of trading opportunities. These two represent the vast majority of the market's opportunities, the vast majority of the market's reliable opportunities. There are a plethora of opportunities out there, but I don't want you to even waste time with things that don't have a high follow through rate. So, speaking of follow through rate, let's talk about follow through rates. So, I, elephant bars have a follow through rate of 70 plus percent. That's right, 70 plus percent. Meaning that 7 times out of every 10, when you spot a green elephant bar, there is more green to come. 70% of the time, when you spot a red elephant bar, 7 times out of every 10, there is more red to come. That's what I call a follow through rate. Write that down, guys. Elephant bars have a 70% follow through rate. All right. There are many events that have a 20% follow through rate of 40%. We don't want those. My magic number is 70% or higher. So I will never teach you something that has a follow through rate that is below 70%. So elephant bars have a follow through rate of 70%, which means that 70% of the time, 7 times out of every 10 times, you should get money. You should get more green. If you enter the elephant, there's more. If you enter the bull elephant, there's more green to be had 7 times out of every 10. If you enter the red elephant, there's more downside to be had 7 times out of every 10. That's important. All right. Now, the tail bar has about the same. So the tail bar has about a 70% follow through rate. Same thing. Both are similar in terms of their follow through rate. So your bottoming tail bar will have more upside seven times out of every 10. Your topping tail bars will have downside flow or downside movement or downside follow through 7 times out of every 10. But I'm going to share something very special with you. Get this. Oh, yes. Sometimes you'll get dual bottoming tail bars and dual back-to-back topping tail bars. All right? Guess what? Oh, no. When you have a stock that has produced 2 bottoming tail bars in a row, 90 freaking percent follow through. Guys, this is one of the most reliable things in the world out there. Dual, and don't even let me start talking about triple tail bars. But dual and beyond, dual, triple, these things have 90% follow through rate, which basically means if you are in somewhere close to the end of the formation of that tail bar, you have a 90% chance of going home with money, 90% chance of follow through, 90% chance of more upside to come, which basically means, don't forget, 90% of the time, 9 times out of every 10, you get follow through to the upside, and 9 times out of every 10 tries, you get more downside if you have dual back-to-back tail bars. That's how reliable they are. And so because of this higher reliability, my traders are taught to play these more aggressively, to play these with more size, to put more money at risk on the dual and triple bottoming and topping tail bars because the reliability is so high. Now, don't forget your numbers. The elephant bars will have, you're going to do that about 60% of the time, and that has a 70% follow through rate. All right. Tail bars, you're going to do these 15% of the time, And they have a 70% follow through rate. I know it's hard for me to draw very well with this, but you get the point. But dual, I'm going to put dual tail bars, they're going to happen, oh, not even. They don't happen very often, something like 2%. But when they do, OMG, 90% follow through rate. So we've got 3 things so far, right? I've shared with you 3 things that are going to make up the crux of your trading approach. These are where the most reliable activity is, the most reliable opportunity is. There's opportunity all over the place, but a lot of it's not reliable. We only want to carve out the most reliable opportunities out there. So you've got 3 things so far: elephants, tails, and dual tails. Okay? Now, how do you know that it's a tail bar? Well, the tail bar, in a sense, the best tail bars are similar to elephant bars. They're a little larger than your normal bar size, and the majority of the bar is tail. All right? They don't have to be, but the very best ones, the creme de la creme, are relatively sizable. All right? Okay, now, the last event, this is the last one. We have elephants, tails, dual tails, and 180s. I call these 180s. I call these 180s to represent the fact that this is almost like a 180-degree turn in your stock. So first, the bull 180 is first experiences a bear elephant bar, which suggests downside movement. Remember, elephant bars have a 70% follow through. Bear elephant bars have a 70% follow through to the downside. But in this scenario, there is no follow through, and there's an immediate wiping out of the red bar by an even more powerful green elephant bar. So the green elephant bar overshadows the red elephant bar. It dwarfs it. It absorbs all of its power into itself. It annihilates it. It erases it. The red elephant bar has no more significance now because the green elephant bar has totally dwarfed it in power and significance. And so now everything goes to the bull green elephant bar. All the benefit of the doubt goes to the green now. And this is what's called a bull 180, a 180-degree turn created by the bulls. Boom! Now, check this out. This has an 80% follow through rate. Boom! 80% of the time, you're going to see higher prices after this event. 80% of the time, you're going to see lower prices after this event. Write that down. 80% follow through rate. Very, very reliable. Extraordinarily reliable. And I want you to make a note of this as well. This, out of all the things I've explained to you, this is your most powerful. By a little bit, not by a lot, but it's your most powerful, which means that statistically, the 180 plays produce the biggest, longest runs in your stock. All right? So the 180 edges out the others in terms of maybe the 180, when you identify it, has more money in that play than the others because it statistically produces longer runs in the stock. All right? So don't forget, guys, look, we've got our, I just want to make sure that we are okay here. All right? So we've got our events, right? We've got our events. Let's very quickly review them again. The elephant bar, that's the main one. Do you understand? Why is that the main one? Because you're going to experience that one 65% of the time. So you're already That is the predominant one that you're going to get. All right. The market delivers elephant bars more than the rest. All right. That has a 70% follow through. That's item number one. Item number two, tail bars. Tail bars have about 70%. Bottoming tail bars up, topping tail bars down. All right. 70%. But when they're back to back, they jump exponentially to a 90% follow through rate. All right. That has to be one of your special heavy plays. Now, that has a 90% follow through rate. The regular tail bar has a 70% follow through rate, but they don't happen as often as the elephant bars. So the elephant bars happen only 15. The elephant bars happen 60 to 65%. The tail bars happen 15%. The dual tail bars happen maybe 2%. Okay? Now, the 180s, this is a special one, not just because it has an 80% follow through rate, but because it statistically produces the most money. It statistically produces the longest winning runs from that event. And so they maintain or hold a very special place in our arsenal of tools. Okay? They don't happen as often. They happen something like 5% of the time, but they're too powerful for us to let go. They're too big of a moneymaker for us to let go, even though they don't happen that frequently. So I would say 5 to 8% of the time, you're going to be able to identify 180s. Now, when we put all of these together, elephants, tails, dual tails, 180s, all of these together, you have the vast majority of the market's most reliable events in your arsenal. And now, the only thing that's required, with these four things, you have reliability. That is guaranteed. You have reliability now. You don't have to worry about reliability. You don't have to worry about consistency. You don't have to worry about tremendous amount of stop outs and things of that nature, because the reliability and consistency is built into the four things. What we have to do now is we have to wrap around each one of these things proper trade management, proper trading. Just being able to identify the event doesn't automatically make you a great trader. There are many people who can identify opportunities, but they have no freaking clue how to utilize the opportunity that they can identify and make money from it. You have to know how to enter it properly. You have to know how to protect yourself in the cases that it doesn't work. You have to know when to add and double up on the play. You got to know when and where to take profits. That's all part of trade management wrapped around the four big ones, the four big plays: elephants, tails, dual tails, and 180s. All right? Are we ready to now map to structure the detail around these four things? Are you ready? I'm not going to move forward until I see you say yes. Yes, I am ready, Oliver. You ready to take notes on this? You're ready to go to the detail level so that now you know the four things. We've got to wrap detail around the four things. All right? Are you ready? Let me know. Yes? All right. Beautiful. All right. I love this. Guys, it's like 43 years and I still love it like a little kid, like a freaking little kid, like a little baby. All right, let's go. Let's go. All right, let me get the slides back up here. Little babies. All right. Okay. So we got the four things. Guys, very quickly, I already talked to you about this. Your elephant bars need to be more sizable than your average bar. This is just an image showing you that even with the bull and bear 180s, the best ones are sizable in nature. Okay, step 2. All right, let's go, guys. How do you enter these four events properly? This is very important. Your entry is important, guys. If you know how to identify the event, but you enter the event too late, you've dramatically affected the odds and the consistency of the play. If you enter too early, you're going to increase your stop outs. If you enter too late, you're going to cut down on you're going to do two things. If you enter too late, you're going to cut down on the potential profitability, and you're going to increase your losses by from the 30% that don't work. Remember, most of these things have 70, 80% follow through rate. That doesn't mean that you're not going to lose on them. That just means that you're going to lose less on them. But we don't want to exasperate the losses by entering too late. Okay? So knowing when and where to enter each one of these things is important. This is step number 2. Now, there are 2 ways to enter each one of these plays. There's the anticipation entry. And this is, by the way, the anticipation entry is the safer entry. Most people don't realize that, but it's the safer entry. The anticipation entry on an elephant bar is when you buy into the elephant bar before the elephant bar is finished forming. So we're going to assume that we're using a 2-minute chart. All right. So this is a 2-minute bar. All right. Now, an anticipation elephant bar means that you're going to buy into this bar before the full 2 minutes is over. So look at what I have here. It's 1/2 to 2/3 of the bar we need. We need 1/2 to 2/3 of the bar of this 2-minute bar finished. So 1/2 is the 1 minute mark. All right. So 1 minute into the bar to something like 1 minute, I'd say, and 40 seconds. Anywhere between 1 minute, that's a little on the early side, to 1.5 minutes, 1 minute and 40 seconds or so, you're entering before the 2-minute bar is over. You're inside of that elephant bar with your money. You have put your risk, you have put yourself inside of the bar. You're not waiting for the bar to finish. Now, if you do this too early, you run the risk of the elephant bar disappearing on you. Elephant bars that form in the first few seconds of the bar, they're not real yet. You need time to prove that the elephant bar is going to remain an elephant bar all the way through the 2-minute bar. So I would say the closer you enter toward the 1 minute 40 seconds is better. So 1 minute is okay, but there's still 1 minute to change the elephant into something different. But if you enter at 1 minute 30 seconds, 1 minute 40 seconds, there's not enough time left in the bar's duration to change the nature of your elephant. So you can be sure you are buying a true, real, substantial elephant that's not going to change to a little mouse on you. We don't want the elephant changing to a mouse on us. So don't get in too early. Anytime after 1 minute is acceptable. Closer to 1 minute and 30 seconds is better, in my opinion. That's called the anticipation entry. If we're looking to play to the downside, we want to short or go into this elephant bar before the 2-minute period is over. So about 1 to 1 minute. That's a little early, as I told you, but 1 minute to 1 minute and 40 second mark. The closer you are to 1 minute 40 seconds, I think is a little bit better. All right, 1 minute 30 seconds, 1 minute 25 seconds. Really close to the 1 minute mark. Again, you have too much time still, in a way, for this red elephant to shoot back up on you. All right, so don't jump the gun too fast. You're going to increase the odds of your bad plays. You're going to increase the odds of your stop outs if you act too quickly. 1 minute, 30 seconds is the gold standard. You can do it after 1 minute, but 1 minute, 30 seconds more or less is the gold standard. All right. That's how we jump inside of elephant bars using the anticipation entry. Now, sometimes you're just not going to be able to get into the elephant bar. Sometimes you're going to miss it. Sometimes you're not going to see it in time enough. And sometimes you'll just want to say, you know what? Let me wait a little bit longer. I'm going to let the elephant bar finish, and I'm going to get in on the very next bar that clears the elephant bar's high or low. So boom, this is the very next bar that clears the high of the elephant bar that I liked. All right? That's called the confirmation entry. Now, when you're using the confirmation entry, you do not wait for this bar to be more than a minute or so. No, this one doesn't have a time requirement. You can get into that second bar in the first few seconds. You can get into it at any time it crosses the high. Same thing here. You can get into the confirmation entry bar at any moment it clears the low of the elephant bar, the bear elephant bar that you liked. So you are piling into bar number 2 here. All right? The one that starts following through on the elephant. So there are 2 ways to enter, right? 2 ways to enter. Anticipation. This is your safest one. It's your safest entry because your protection is closer to you, which we'll get to. The confirmation, your protection is a little further. So some people automatically assume confirmation is safer. No, anticipation is safer. Confirmation is acceptable, but anticipation is safer as an entry method. And there will be times you're going to use both of them. You might decide that confirmation is better this time, or you can't be, let's just put it this way, you can't be wrong with any one. You can be better, but you can't be wrong, right? I want you to understand that. You can be better. Sometimes anticipation is better than confirmation, but you can't be wrong doing confirmation. Sometimes confirmation is better than anticipation, but you can't be wrong doing anticipation. All right? You can just be better. You can't be wrong. These are the 2 ways we enter elephants. The 2 ways we enter tail bars are we have an anticipation entry on the tail bar. Now, this is important to understand. If your tail bar stays normal, you're going to use, I should do this first. If your tail bar stays normal like this, what's normal? The body is little. The tail is sizable, but the body's little. That's a normal tail. If your tail bar stays normal, you should be using confirmation, not anticipation. You should be buying as soon as the next bar clears the high. As soon as the next bar clears the high. Boom! So normal tail bars get confirmation entry. Same thing. As soon as the next bar clears the low of your topping tail bar, as soon as the next bar clears the low of your topping tail bar, that's called confirmation entry. Anytime you are not buying or entering the event itself and you are entering after the event has completed, you are using confirmation. Anytime you enter the event itself, you are using anticipation. Now, here's anticipation tail bar. What has happened with the body? Look at what's happened with the body. You have gone from having a normal body, which is little, then all of a sudden the green stops being normal. You're like, wait a minute. Let me make that smaller. You say, wait a minute. This body is no longer little. This now qualifies as a torpedo tail bar. Torpedo tail. Boo! I'm going to buy into that green bar before this bar finishes. As long as I'm past 1 minute to 1 minute 40 seconds, more or less. Remember, the gold standard is about 1 minute 30 seconds. As long as I'm around that 1 minute 30 seconds, boom, I can buy into the bar, even though there's more time left in the bar's formation. I am anticipating that this bar is going to close as a tail bar. I am anticipating. You see, we were normal here, and we stopped being. We kept growing the body. Boom! I am anticipating that this bar is going to end like this. I am entering the bar. Remember, 1 minute, 30 seconds is that gold standard. Boom. So, once again, anticipation entry on the tail bar, confirmation entries on the tail bar when the body's small. So, body's small, confirmation entry. Body on the tail bar is not so small, get inside the bar. 1 minute, 30-second anticipation. Okay, entries on the 180. All right, this by default is a confirmation entry. All right, you are buying the green bar as soon as it crosses the high of the red bar. Boom. You are shorting the red bar. Boom. As soon as it passes the low of the green bar. Remember, in the 180s, what's significant is the fact that you are wiping out the opposite color. You are wiping out. How strong do you have to be to make an elephant disappear? See, this green bar, this elephant made the other red elephant disappear. That's strength. This red elephant made the green elephant disappear. That's sheer power. That's why we want to bet with the sheer power. All right. So as soon as this bar does not have a time restraint. Anytime you are entering above or below something, there's no time. The time is when you're anticipating, but there's no time requirement if you have a high or low reference point. In this case, we're buying the green above the high of the red anytime it happens. And here we're shorting the red anytime it crosses below the green. There is no time restraint or time requirement for this. All right? And that's how we enter. So guys, look at this. We have covered 2 of the 6 steps I'm going to be sharing with you. You must identify the right opportunity. It must be an elephant. It must be a tail bar or a dual tail bar or a 180. You are not interested in anything else. You're not to be dragged over here because this looks shiny. No, you're not to be dragged over there because there's news on this stock. Oh, well, they're mentioning this stock on CNBC. Novice. All right. Oh, this one's jumping up and down and doing backflips. Novice. If it's not an elephant, if it's not a tail bar, if it's not a dual tail bar, if it's not a 180, you're going to sip coffee. Do you understand? You're not going to be tricked. You're not going to be drawn to something. You're not going to let television or news programs like CNBC take you off your plan. Please, I am telling you, this is the key to consistency. You can't get consistency by doing things inconsistently. Consistency doesn't come from the lack of consistency. You need to do things consistently. So we only play elephants. We only play tails. We only play dual tails. And we only play 180s. That's the first thing. Second thing, you know precisely when to strike. The trader that does not know when to strike is wasting his time and talent on knowing what to pick. So the trader can be talented at identifying an elephant bar, but if they don't know when to strike, that talent is worth nothing. Do you understand? Nothing. You got to combine these two. Enter wrong and you're breaking down the odds. All right? Enter too late, you're breaking down the odds. Enter too early, you're increasing the bad part of the odds. We have to know when to enter. So anticipation, the golden time, that golden time is around 1 minute, 30 seconds into the 2-minute bar. Confirmation is above the bar or below the bar. Boom. Right? That's all you need to know. Let's get back to this. All right. I hope you're taking notes. All of this is important. All of this is important. Okay. Step 3, know how to protect yourself. Guys, I didn't say that these things were 100%. Because if they were 100, if they had 100% follow through rate, we would not need protection. We would not need an insurance policy. We would not need protective stops. This is not the real world. This is real trading. It's not Disneyland. It's not your dreams. All right. When you stop watching Disney movies and you freaking wake up, you realize that I am always going to have to deal with loss. Loss is a permanent part of this game, but I need to know how to manage my losses professionally. I need to know how to control my losses professionally. I need to know how to deal with them professionally so that the losses don't take me out, so that the losses don't take away my 70% wins. So 20 to 30% of the time I'm going to lose, which means that 2 to 3 times out of 10 times, I might have to deal with a loss. But as long as I deal with that loss appropriately, I'm going to be fine. 7 wins, 3 losses, fine. 8 wins, 2 losses, fine. Sometimes 9 wins, 1 loss, fine. That's the world I want you living in. Now, the main protection is what I call the 1 bar stop. If you enter an elephant bar, your stop is going to be 1 bar, the bar that you jumped into, the bar that you identified. You identified an elephant bar, that's going to reference your stop. You don't want to lose your event. This is your event. You have dived into the bar with your capital. Now, protect yourself 1 penny, not 2 pennies, not 5 pennies. Oh, well, I get some traders that Oliver, some traders that say, Oliver, how far below the elephant bar should I put my stop? What do you mean? Right there, 1 penny. If you could split the penny, I would say half a penny. If you could split the half, I would say 1/8 of a penny, 1/10 of a penny, 1/8 of a. Do you understand? Don't give this any extra room. Don't increase your loss potential. You want that as tightly snugged up there under that elephant bar right there. All right. No filtering, no giving it extra room. But I want to give it extra room. No extra losses. 1 penny under that bar. Okay. So 1 penny under the bar. If you are shorting an elephant bar, boom, you're in the bar. Your next step is to place your stop 1 penny above the high. No exceptions. If the market removes the very bar that you identified as the opportunity, if the market removes your opportunity, why do you still want it? Why do you still want it? You should not want. This is what got you into the play. Now the market removes it like this. What we're covering here today, all right? What we're covering here today is going to radically change your trading and the odds of your success. There are millions upon millions of people who do not have these foundational steps in place. So I need you taking these notes. I need you making sure everything step by step, these 6 things, step by step, every single trade, you identify properly. You entered it properly. You protecting yourself properly. All right? Let's go. Let's get back to let's get back to the. Here we go. Give me a second here. Don't leave, guys. If I have issues, we're going to keep coming back. We're going to keep coming back every single time. Don't leave. I need you to get everything here. All right? I've never done this before. This is why I told you we're going to take this over the top this time. All right? This is the big one. You need all of these things. All right, let's go. Okay. Wait. Give me a second. I need my pen up here. Murphy's Law. All right, here we go. All right. So I don't want you losing more than 1 bar. Guys, let me just tell you this. You've heard me say this before. You've heard me say this over and over and over again. If you limit your losses to 1 bar, you're going to be in this business forever, for a long time. The market will never remove you if you limit your losses to 1 bar. You see, the problem that most people have is that they allow the market to take them out. The market wants to take you out in the beginning, right? The market wants to issue you. All right, the market wants to keep a very tight number of successful traders that pull money out of it. It protects that group. It doesn't like new members. So it tries to take you out in the beginning. But you're going to be guaranteed that the market will never be able to take you out if every single loss is 1 bar, 1 bar, 1 bar, 1 bar. Okay? Or the majority of losses are 1 bar. So if you get 1 bar loss, your wins are going to take care of that. You're going to have 40 bar wins, 20 bar wins, 15 bar wins, 8 bar wins, 4 bar wins, 3 bar wins, 7 bar wins, 14 bar wins, 12 bar wins, but every single loss is 1 bar. And so when you put all of your trades together, let's say you put 20 trades together, you might experience 4 losing trades, 16 winning trades, 4 losing trades, but every 4 losing trades is limited to 1 bar. And the others have been allowed to run. Maybe out of that 16, you get a 10 bar run, a 4 bar run here, a 30 bar run there, a 6 bar run here. But every single loss, 1 bar, and you're in this game forever. If there's one thing that you should maintain for the rest of your life, is this general 1 bar loss rule. Okay, let's go. Okay. So 1 bar loss, enter 1 bar stop. Enter 1 bar stop. Okay, now enter confirmation, 1 bar stop. Enter confirmation, 1 bar stop. Boom. All right, that's easy. 1 bar stop. Enter anticipation on a torpedo bar. Boom. 1 bar stop. Enter on an anticipation entry with a torpedo bear bar, boom, 1 bar stop. Don't lose more than 1 bar. This is your bar. Out. This is your bar. Out. Your wins will take care of this. Don't worry about losing 1 bar. Your wins are going to take care of 1 bar losses. All right? Same thing here. Enter, boom, 1 bar loss, 1 penny. Enter 1 bar loss. Boom. Enter 1 bar stop. Boom. Enter 1 bar stop. Boom. Don't play around. Out. Move on. No big deal. Your wins are going to take care of your losses. Your 1 bar losses. Okay? Same thing with the bear 180. Your enter 1 bar loss. Boom. Enter. Boom. Where's that red bar? 1 bar loss. Don't worry about losing this. The wins take care of 1 bar losses. The wins do not take care of more than 1 bar losses. They take care of 1 bar losses. First thing I want to cover with you is the fact that first of all, there are 5 dominant moving averages in the markets. Now, guys, listen, I know there's an infinite number of moving averages. I am telling you, I have done the work for you over 3+ decades, and there are 5 that have the greatest degree of relevance, and you can do away with all the other 5. But out of these 5, which I'm not going to deal with today, I'm going to pull out the 2 most important of the 5. And the 2 most dominant moving averages that I want you using on every single chart, every single market, every single time frame is the 20-period simple moving average and the 200-period simple moving average. Now, I know that there are a variety of different styles of moving average. There's the simple, there's the exponential, there's the weighted, there's the triangular. Listen, once again, I've done the work for you. I have found in over 30 years of playing the markets from a technical perspective, I have found no hardcore evidence that the sexier varieties of moving averages have an edge over the simple. So whenever I'm given a choice to do something a little more complex or to do it more simply, I default to the simple. And I think that's a very good general guideline for life. If you have two choices, one is more simple than the other, then I would opt for the simple, because power resides in simplicity. It does not reside in complexity. The more complex you become with your trading plan, the weaker the trading plan. The more complex you come, you build a mechanism, the greater the odds that something goes wrong and something breaks. The simpler, the more powerful. The fewer moving parts, the more powerful. Remember that. So simple moving averages, 20 period simple moving average, 200 period simple moving average. Now, these moving averages are so important, traders, that I don't consider a chart of any kind a chart unless you have these two moving averages superimposed on the chart. And this applies to any market. I don't care what you trade. You want to trade cryptocurrencies? You better have that 20 period moving average and the 200 on there. You want to trade options? You better have the 20 and the 200 on there. You want to trade Forex? You better have the 20 and the 200 on there. You want to trade stocks, options, bonds? It doesn't matter. Every market in the world, you're going to superimpose the 20 and the 200. In addition to that, it doesn't matter what time frame of a chart that you're looking at. 1 minute, 2 minute, 3 minute, 5 minute, 1 hour, 1 day, 1 week, 1 year, 1 decade. I don't care. You're going to have the 20 period. You're going to have a moving average that's averaging the last 20 bars of whatever time frame, and another moving average that's averaging the last 200 bars. Very important. Now, what I want to show you based on what I want to demonstrate here based on this image that I created for you is that note that the 200 period moving average in this case is relatively flat. And note that the 20 period moving average is above the 200 and it's rising. It's gradually rising. All right. That picture, I want that picture to be seared into your mind, because this is called the picture of bull power. I'm going to repeat this. A rising 20 over a relatively flat 200 is considered to be the bull picture of power. It is power on the buy side. And when you have this picture, the predominant action, the predominant right action is to buy, and to preferably buy dips and breakouts. All right. This is the picture that you utilize to know when it's appropriate to be a buyer, not a seller. And when dips, and what do I mean by dips, guys? Let me bring my Epic pen up here. This is a great pen, by the way, guys. All of you should have this. It's free. All right. Let me bring my pen up here. Let me show you this. So when you have this picture of power here, you know that dips are buyable, because dips will tend not to be temporary. But there's a time when dips are not buyable. But when you have the picture of power, dips are buyable and breakouts are buyable. So dips are buyable and breakouts are buyable. Breakout and dip. All right. Dips are buyable and breakouts are buyable during the picture of power. So make sure, and I will tell you this, if you make sure that you only buy when something has the picture of power, or the majority of your buys are during the picture of power, it's going to be hard to get trading wrong. It's going to be difficult for you to lose consistently, because you're playing with the flow, you're playing with the power, you're playing with the trend. And let me tell you this, over 85% of all losing trades are the result of playing against the trend, playing against the power. So by playing the picture of power properly, you're going to get rid of 85% of your losing trades. All right. So that's the picture of power. Rising 20 Picture bull power rising 20 over a relatively, doesn't have to be totally flat, a relatively flat 200. Now, here is the picture of bear power. It's just the opposite. Relatively flat 200. Again, it doesn't have to be perfectly flat. It can have a little tilt to it, but it's relatively flat. Okay? And there's a reason for that, which I'll get into. But relatively flat 200, and your 20-period moving average is gradually declining. All right? This is the bear picture of power. And in this picture of power, you are not to believe in any moves to the upside. So moves to the upside, boom, tend to fail. Moves to the upside, boom, tend to fail. Moves to the upside, boom, tend to fail during bear picture of power. And again, 85% of all losing trades, 85% are traders coming in to a rally that they believe is a turn in the market. They believe this rally is a turn, but it's within the bear picture of power. And these rallies are usually false or very short-lived. Okay? And so you can't get caught in these moves to the upside. Oh, the bear market's turning. Oh, the stock's about to go up. Not during the picture of power. We doubt the up moves during the bear picture of power. I'm going to repeat that. We doubt the up moves during the bear picture of power. Now, traders, listen to me. If I could convince you that the only time you buy is during the bull picture of power, and the only time you bet to the downside is during the bear picture of power, I'm telling you, I could probably, just like that, turn a good portion of you instantaneously profitable in your trading. Instantaneously, without much work, without much effort, just not allowing you to do anything but go long during the bull picture of power and to go short during the bear picture of power. Why? Because I would be instantaneously removing 85% of all of your losing trades. 85% goes away with just this basic concept here. Now, we're gonna build on top of this. We're going to build something very powerful on top of these pictures. All right, let's go back. Okay, so we've got this out of the way. Bull picture of power. Bull picture of power is here. Boom. Bear picture of power there. Boom. All right, now let's talk about the market's 3 states. There are only 3 states that the market vacillates between. And I want to talk about these 3 states. And let me tell you this, each section is going to deepen your ability to read the market properly. Now, let me just say this. You must always know which of the 3 states your stock or your cryptocurrency or your option or your Forex pair, whatever you're trading, you must know which one of the 3 states is in. Because if you don't know that, you're a novice and you're gambling. You're not trading. It is impossible to trade properly without knowing which of the 3 states you're in. So we're going to settle this once and for all right now, so that from this point onward, you will never not know what state your item is in. Never from this point onward. And you will forever be conscious of the state. So let's go into it. The 3 states that every single market, irrespective of their time frame, 1-minute chart, 2-minute chart, 5-minute chart, hourly chart, daily chart, weekly chart, it doesn't matter. Stocks, options, bonds, cryptocurrencies, futures, Forex, doesn't matter. They all operate the same. They vacillate from a narrow state. They move to a neutral state. That neutral state eventually moves to a wide state. That wide state moves back to a neutral state. The neutral state moves back to a narrow state, and repeat. So let's go over this again. I want you to assume that this is the 20-period moving average. It is the 20-period moving average. This is the 200-period moving average. When your 20 and your 200 are relatively close together, they don't have to be touching. When they're relatively close together, and preferably when your 20-period moving average is laying on its back. I'm going to repeat that. Preferably when your 20-period moving average is laying on its back, that's the best. So you can have narrow like this. 20-period moving average is declining into my 200. You see that? And that's narrow. But that's not the best narrow. The best narrow is this, where my 20-period moving average, here's my 200, and my 20-period moving average has started to lay down on its back. So that now my 20 is relatively flat along with the 200 relatively flat. That's the best of the best narrow states. And so on the left-hand side, you see narrow state. The 20 and the 200 are relatively close and the 20-period moving average is flat. In the middle, you see a wide state where the 20-period moving average and the 200-period moving average are far apart from each other. So you've got the narrow state, wide state, narrow state, and where's the neutral state? Well, it's in between. Neutral is in between, where you can't say it's terribly, it's not very narrow, but it's also not very wide either. And so here are your neutral states. Now, here's your wide state. And here's your narrow state. You must know every single time you take a look at something, you must know what state it's in. Because every state requires a different strategy. The narrow state strategy is different from the wide state strategy. The neutral state has a different strategy, different strategies that work the best than the wide state or the narrow state. All right. And so here, I'm going to very quickly tell you, in your narrow state, the breakout game is your best game. The breakout game is your best game. In the neutral state, the dip game, the dip and the color. Buy the dip here. All right. Sell the dip here or sell the rally here. So anyway, this is the buy the dip stage. This is the buy the breakout stage, and this is the fade the market stage, which is the go the other way. All right. Now we're going to talk about this in greater detail. All right. This is the short the rallies stage. So we sell the rallies, we buy the dip, sell the rallies, fade the market down here, buy the market up there. Now, I'm going to go into greater detail with this. Don't worry if I'm going a little too fast for you. Trust me, I just want you to understand the three states. Narrow when the 20 and the 200 preferably are both relatively flat and close together. Wide when they're far apart, and anywhere in between that is neutral. That's all I want you to understand right now. These three states. Now, the narrow, neutral to wide, back to narrow can also happen down. See, this is the picture of the cycle up. Here's the picture of the cycle down. Your cycle is down now. So where you have the 20 and the 200 on the left-hand side are relatively flat, close together, and the market drops down from narrow to wide, wide back to narrow. And so, again, you must know what state is your market in. Is it in the narrow state right now? Is it in the neutral state? Is it in the wide state? Because there are different strategies that work the best for each one of the states. All right? And so we're going to delve into this a bit. and look at example. We're going to look at a lot of examples of this, okay? All right, so now understand that every single market does is vacillate from narrow to wide back to narrow. Narrow, let me do this again. Narrow to wide, it could be wide up or wide down. Back to narrow, and repeat. Listen to me carefully. There is nothing else the market can do. The market is a breathing mechanism. Many of you know this because I've taught you this, right? The market is a breathing mechanism, traders. It inhales, narrow state. I guess that would be narrow state, yeah? And exhales, wide state. Inhales, and then exhale. And we must know, is the market in an inhale state or is it an exhale state? All right? Because by knowing which extreme the market is in, we can put ourselves in a position to know what's next. Because after I've inhaled, there's only one thing next, the exhale. After I've exhaled everything out, there's only one thing next, inhale. And so by catching the market at its extremes, extreme narrowness, extreme wideness, we can know with the highest level of probability what the market is going to do next. From here, the market should drop next. From here, the market should move up next. From here, the market should move down next. From here, the market should move up next. It is only, listen to me carefully, it is only by knowing where your stock is on that breathing cycle. You understand? It is only knowing where you are that gives you the edge of what is going to happen next. Now, we can't read the future. I'm talking about probability. I'm talking about odds. You understand? So your odds go up of knowing what's next. Up is next. Down is next. You understand? That's the master trader's edge. Not being able to read tea leaves, not being able to read the future, just being able to get that slight additional edge of knowing what is more likely, which direction is more likely. Now let's get back to the teaching here. All right? Now, let's talk about the market's 4 best locations. So we had the cycle of how the market cycles through narrow, neutral, wide, wide, neutral, narrow, and repeat. Now let's talk about what are the 4 best locations to act along the way. Boom. Here we are. Now take a look at this carefully. Look at it carefully, traders, okay? Look at it carefully. Look at in the narrow state above the moving averages. In the narrow state above the moving averages, this is the best location to buy, to bet long, to bet on the upside. This, conversely, in the narrow state but under the moving averages, this is the best location to bet down. So the best location to bet down would be here. Boom. The best location to bet up is here. Narrow state above the moving averages, narrow state below the moving averages. The best location to go long from a wide state is here. The odds favor the upside after wide. And the best location to bet down is from here after wide, the odds favor a pullback or a drop because of profit taking. Now, think about this. Think about you buying here and the move in the stock gets here. You're going to be more and more inclined to sell for profit taking. So the higher this moves, the greater these traders or players start coming out, which applies the pressure this way. All right? So it makes sense. So no, these are, now listen to me carefully, traders. If I can get you to only buy where the green dots are and to only sell or go short where the red dots are, boys and girls, I can frickin' turn you into master traders. Do you understand this? This is not rocket science. I have told you this for decades. This is not rocket science. It is not overly complex. In fact, it's overly simple, this game we call trading. But it is you that makes it more complex. It is you that brings the complexity to the market. It's you that brings the difficulty to the market. The market is simple. The market is basic. The market is primitive. The market is rudimentary. You're the complex one. You're the confused one. You're the one that comes with your lack of discipline. You're the one that comes with your lack of training. You're the one that comes with your sloppy trading plans. You're the one that comes with your gambling and casino-like behavior. You're the one that comes with your irresponsibility. It is those things that make this game we call trading complex and difficult. But in reality, it is not. I want you to think about this. I am so far teaching you basic things that a 6 or 7-year-old can understand. Blue line over the red line. Now, this time, the blue line is under the red line. Think about that. The blue line and red line are close together and flat. Now, the blue line and red line is wide. It's not complex. When wide, bet the other way. When narrow, bet with the move. If it's over, buy. If it's under, sell. I mean, think of how basic these concepts are. And there's this tendency on the part of humans to believe, for whatever reason, especially humans from the West, there's this tendency to believe that if it's not complex, it must not have validity. If it's not complex, it can't be that simple. Yes, the most powerful things in life are simple. Do you understand? The most powerful things in life are simple. So let's stop overcomplicating these things. If I could get you to just play these locations, I am telling you, I can take you to the finish line. The problem I have is that you won't do it. But if I can get you to do it, to just act where these dots are, the green ones buy, the red ones sell, I am telling you, I can take you all the way to the finish line. And you can take this activity we call trading. You can take this thing to the finish line. It can change your life. It can change the lives of your family members. It can change your family generationally. It can make you independent and make you financially independent and make you free. Because in this game we call trading, you don't need a team. In this game we call trading, you don't need a boss. You don't have a boss. You don't need a team. It's just you, your laptop, and an internet connection, and you can trade from frickin' anywhere. I'm in Madrid, Spain right now for the last 2 months just because I like it. Just because I like it. This activity changed my life in a profound way, and I've seen it change lives of thousands of people in the same profound way. I wanted to do that with you, but you've got to listen to me. I am telling you, there is an easy way to do this and a hard way to do this. One of the easy ways is to find someone who has been doing it correctly for a long time and just listen. Get trained, educated by that person, and cut your learning curve exponentially. Otherwise, it's going to take you decades to get this. So it's your choice. The shortcut is find someone who does it really well, who's been doing it well for a long time. The long time is important because doing it well for a short time could be just the market. They got lucky. A rising tide raises all boats. I mean, think about this, guys. Most of the professionals that claim to be professionals in this game, they've never seen a bear market. Think of all the YouTubers out there with trading channels. They've never seen a bear market in their lives. The last bear market was 15 years ago. What did they start trading at 2? At 5? At 10? I doubt that. They've never experienced this before. They've never experienced things that go down more than they go up. So you want to find someone who knows what they're doing, does it well, and has been doing it well for a long time. And that will dramatically curtail your learning curve. Otherwise, I will tell you this. If you think training is expensive, try ignorance. Try not knowing anything. Try taking your family's money and learn by trial and error instead of someone saying, wait a minute, that's a dead end. Don't do that one. Don't go down there. Don't do that. Don't do that. Do this, do that. Don't do. It is very expensive to do this alone. It's long and it's very expensive. The most expensive way. All right, let's get back to it. All right, so we've got the dots, we've got the locations. Let's go to the next thing. We're deepening this, and I will show examples, guys, of all of these things, a lot of them. All right, so I won't let you. So we're betting on the up in the greens. We're betting on the downs in the reds. And remember what I told you in the beginning. If you're in between, you're color change playing. So you're playing color change, dips, and then the color change right there. All right? Dips and then the color change right there. So there's this neutral way. In the neutral, you're playing the color change. What's a color change? Well, it's just simply a green takes out red. So you're playing this. Anytime a green bar trades higher than a red bar, like that. I'm drawing terribly here, but you get the point. So anytime you get a green bar that trades higher than a red bar near the blue line, that's how you play the neutral. Do you understand? That's how you play the neutral state. From the dots, we play igniting events. And I'm going to get to that. I really want to focus more on the dots because this is where the biggest wins come from. It comes from being able to play the dots well. Your mastery is going to come from being a good dot player, a green dot player and a red dot player. That's where your true mastery is going to come. And we can fill in the other things later, but I want you to be a good dot player. All right, let's go. Now, let's talk about the market's 2 most powerful bars. Now, guys, listen to me carefully. Listen to me carefully. There are 13 bars the market repeats over and over again. 13. It's almost like the market has its own alphabet, and each bar type is a letter in the market's alphabet. And it only has 13 letters in its alphabet. It can only speak and communicate to us through 13 bars. There's not a 14th, there's not a 12th, there's not a 15th, there's not a 40th, there's only 13. And so the market can only throw out one bar at a time. And it's got to be one of the 13. Now, if you know what all 13 bars are and what are the probabilistic can't say that word. What's the probability of this bar producing an up move versus a down move after this bar? When you know those numbers, your game really goes to an extraordinarily high level. When you understand what each bar's probability of an up move versus a down move is, then you know which location in that cycle from wide to narrow, which location each bar is better in. OMG, your game goes to the ultimate level. So you know all the 13 bars, and you know for each bar which location it performs the best in. Oh my goodness. I want to teach you all of those things. I want to teach you all of those nuances, that the between the line stuff, not the basic stuff, support and resistance. I'm a professional. I know support and resistance. No. The real nuance stuff is what separates you from the crowd. You understand? Support and resistance. It's on support. It's very basic. All right, let's get back. All right, the market's two most powerful bars. Now, of the 13, I'm covering the two. I'm pulling out the two that possess the most power. There's 13, but these are the two most powerful. Now, of course, I'm not going to cover 13. Not only do I have time for that, but that's for my traders. But anyway, we will cover two today. And the two are very simple. They're what I call elephant bars and tail bars. Elephant bars and tail bars. So big, fat, green bars and bars that are mostly tail and a little body. So fat elephant bars. Now, why do I call these elephant bars? Because these bars can only be created by big money. You can't create an elephant bar in a stock like Apple. It takes billions of dollars to create an elephant bar. That is no easy feat. All right. So when we see an elephant bar, we know that's big money at play. But in reality, a tail bar is also big money at play, because this bar at one point was red. This bar was red, and the red got eaten up, and then it went past the red to produce green. That's the comeback story. Your tail bar is the comeback story. It turns this bar into that bar. That's the comeback story. It turns weakness into strength. So your tail bar is the comeback story. Everyone loves a comeback story. This is domination bar. This is just the buyers are dominating. The bulls are dominant. That's domination. This is comeback. So comeback and domination. Those are the two bars. Then you have it on the weak side. The bears are dominating. This is pure domination. And this is the comeback story, because this bar was once green at the high, and then the green got eliminated more, until all of the green was eliminated, and it kept going to produce some red. So the bears came back to wipe out the bulls. So these two bars are very meaningful in the markets, and you need to become an expert not only at identifying them, you've got to become an expert at playing them. And so The two ways that we play these, if they're in the right position, which I'll get to, you're going to buy into the bar right toward the end of the bar's formation, or you're going to buy right above the bar if you've missed it. You understand? You're going to buy above the bar if you've missed it. You're going to short below the bar if you've missed getting in the bar. You're going to short right below the bar if you've missed it. Right below the bar if you've missed it. All right? So just remember that. We want to try with the elephant bars, we want to try to get into the bar right toward the end. If we miss it, we want to get the next bar just above it. Just above it. In it or just below it. Just below it. All right? That's how we play these bars. We buy into the elephant bars or just above or below. We get into them at the end, or if we miss it, just above or below. And the tail bars, we always do above or below. I'm going to repeat that one more time. In the elephant bars, we want to get in the bar or just above it if we miss it. In the elephant bar, we want to short in this bar, but if we miss it, we want to short right under the bar. On the tail bars, it's always above the bar we want to get in or below it. All right, tell me you understand this. You got it? I want to see you. I want to see your comments. I know I'm on a delay, so it might take me a minute or so to see your comments, but I just want to make sure. I want to make sure. It's that important to me. All right? I want to make sure. Let me see your comments. You got this, guy, so far? You got it? Make sense? A few of you let me know. Good, good. Now, guys, I'm going to show you example after example after example of this. All right, we're going to get this down pat. My goal here, I need you to walk away from this knowing exactly what to play, knowing exactly when to play it, when to strike, and how to protect yourself in case it doesn't work. I want you to walk away with this today. All right, let's go. All right, let's go. Boom. All right. So, guys, if we are in the bar or just above it, you protect yourself right below it. Right below it. If you are shorting in the bar or right below it, you protect yourself with a protective stop right above the event, right above the power bar. There's only 2 power bars. You don't want the market to remove your power bar. All right. So if this were to drop, boom, you're out. If you were to enter here and it were to drop, boom, you're out. If you were to enter here and this were to move up, boom, you're out. Sorry about that. If you were to enter here and move up, boom, you're out. So this is my lose 1 bar method. Guys, let me tell you this. I've always told you this. If the majority of your trades, you lose 1 bar, you're going to be in this business forever. Do you understand? Forever, forever. The market will never be able to take you out if you limit your losses to 1 bar. Think about that. The market will never be able to eliminate you, never be able to kill you, never be able to destroy you. You will be in this game forever if you limit your losses to 1 bar. I give you 1 bar, market, and you get fired. If you take this bar away, I fire you. If you do that, you will be in this game forever, because just by pure basic mathematics, Some of your plays are going to produce 4 bars. 4-bar wins, 1-bar loss. Some of your plays are going to produce 8-bar wins, 1-bar loss. You're going to win 14 bars, 1-bar loss. You're going to win 40 bars, 1-bar loss. 3 bars, 1-bar loss. 2 bars, 1-bar loss. 1-bar win, 1-bar loss. 8-bar win, 10-bar win, 13-bar win, 40-bar win, 50-bar win. But you will only ever lose 1 bar. If you can do this, if you can play in those dots where I had the dots, and you can play only 2 bars that form in those dots, which I'll cover, and you can protect yourself by limiting your losses to 1 bar, OMG. That's fire. It will be hard to get this wrong. I'm going to show you. It will be hard to get this wrong. All right, let's go. I love this game. Now, I do want to just make this point very quickly here. It doesn't matter whether your tail bars, what color the body is, it's the same. So even if it's a red bar here, you're going to buy above this bar on the next bar, preferably. The next bar. The color of the body is not the important thing. It's the tail that's the important thing. All right. So I just wanted to demonstrate that here. It doesn't matter what color the little body is, the importance lies in the comeback, which is the tail portion of the bar. All right, good. Okay, so let's go. Now, this brings us to directional trading. Guys, let me tell you this. What I'm about to do with you here in this section is I'm going to take you right now. I'm going to take you to being right over 80% of the time in the direction. Let me repeat this. Right now, what I'm going to cover is going to make you 80% or better winner, which means that out of every 10 trades, you on average get 8 of them right. Do you know what you can do with those type of numbers? You can get fabulously wealthy by being right 80% of the time. Some of the best mechanical or algorithmic trading models make millions of dollars, and they have a 38% winning ratio. It's just that when they win, it wins big. 38%. I'm giving you something in this section that's going to give you 80%. It's going to be very powerful. What separates a master from a novice or from even a regular profitable trader, I'm talking about a masterfully profitable trader, is their directional probability. If you get the direction right, you can kind of mess up other things and still be okay. But you can't be okay very often if you get the direction wrong. So it's all comes down to how good are you with directional trading? Because it all starts there. You got to get the direction right most of the time. All right, let's go. So this is going to do it for you. This is going to do it for you. Boom. Now, directional trading. In your narrow state, if you get an elephant or a tail bar that forms anywhere above the narrow state. Now, these can be touching a little bit. It doesn't matter. But as long as they're above the narrow state, above the items, above the 20, above the 200. If you get that any of these 2 bars form there, your direction is very high probability up from here, up from there, up from there. All you have to do is wait for one of your 2 bars to form in the right location. And there's only On the buy side, there's only 3 locations. Well, there's only really 2 locations because this is the same as this. So we can take this one away. There's only 2 locations where buying is appropriate, right above a narrow state and below a wide state. Now remember, here we're playing the color game off the 20, a color game off the 20. That's different. But we're talking about the best locations to start your trades from. There's really only 2. 1, 2. Okay? Now, the best location to short or play down is narrow state under or wide state. All right? So there's only 2 best locations to short from, and there's only 2 best locations to go long from. Color game in between. But again, today I wanted to focus on the most powerful locations. Okay? This is getting your directional trading right. Now, guys, take your cell phone out, take a freaking snapshot of this, take your whatever image capture, screen capture, do something. Pull this out, stick it on your freaking computer, stick it on your freaking refrigerator, stick it on your bathroom mirror, stick it on the headboard of your bed, stick it on your freaking keyboard, stick it on your desk, make freaking wallpaper. Do what you got to do to sear this into your mind, because this can serve as the check. When you're ready to do something, you better make sure you're ready to buy. Is it in one of these green spots? You're ready to short. Wait a minute, let me check. Is it in one of these red spots? No, I'm not doing that. Let this be your guide. Do you understand? Make it your screensaver in your phone. I don't freaking tattoo your wife's forehead or your husband's forehead just so that it's a constant freaking reminder of where the best trades occur from. Do you understand what I'm saying? Do what you got to do, but sear this into your mind. All right? Sear this into your mind. All right, let's go. How to win in a bear market. Why am I focusing on the bear market? Because I believe that we're going to be in a bear market for the rest of the year. And as I mentioned to you earlier, be glad that you are cutting your teeth in a bear market. Be glad that you are going to start deploying what I'm teaching you here today in a bear market, because you will come out head and shoulders above all of these people over the last 15 years that were operating in a market where a rising tide raised everybody's boat, whether they were stupid or not.